Sectoral allocation aids market correction. The Indian market reached an all-time high on December 1st and has been correcting ever since. But will it continue to fall from here? And if it does, what must we do? Hello everyone, I'm Rakshit Pai, and in this video, I'll answer your question. Everybody is saying that the recession is on its way. Should I sell all my stocks? Most of us have this question. In fact, 3 people personally contacted me and asked what they should do next. If you do not wish to experience all the ups and downs and still want to make money from the market, then why not check out Eating Money Genius? It's a professional fund manager at your service. Subscribe to the membership program and let professionals make your investment decisions. Check the link in the description. Now let's get back to the topic. Why Indian market is at an all-time high? After a broad market rally until September 22, the market corrected for around 7 to 7.5% and then came back to form a new high, almost reaching 19,000 points on the Nifty, mainly because of the FII and the strong support of our DII and retail investors. Market reached new heights. Will the new high sustain? From its all-time high, the market has already dropped close to 3%. It seems like we are already in a market correction. The main reason for this is that the Fed has never stopped raising interest rates. When Fed raises interest rates, the Indian Reserve Bank is forced to follow the suit. And when that happens, the liquidity will get squeezed. And thus, all the risky asset classes will get fewer investments. One such asset is equity. Add recession to this mix and we are looking at quite a big correction in the market. What should investors do? Remember, the question was whether to sell all our holdings. The answer is a straight no. Do not ever get out of the market completely. I mean, if you wish to be on cash due to an expected market correction or crash, then please see to it that your cash holdings isn't more than 30%. As a result, at all times, one must have at least 70% of their total portfolio invested in the market. Now your question might be, where to invest during the recessionary period? In one of our earlier videos, I stressed the importance of 3 pillars of the economy. The 3 major sectors in which we all must be invested at all times. Those 3 sectors are BFSI, the FMCG and the IT. Watch this video to learn more about the 3 sectors. But why these 3 sectors and what is their importance during the recessionary period? For this, you must understand the economics behind it. First and foremost, there is BFSI, stands for Banking, Financial Service and Insurance, especially an institution that deals with money. Guys, no matter what, an industry with its intrinsic business being in money management will do the same or a bit better than the country's economic growth. What I mean here is, if you think India will grow by double digit for the next 3 years, that growth is not at all possible without a strong and robust financial infrastructure. Banking and financial service will grow as long as the nation does. Hence it is evident from the fact that the entire index, both Nifty and Sensex, has given 35 to 40% of its weight to this sector. And if recession hits the nation, this sector is the first in line to take a hit. With a recession, money circulation becomes that much more difficult. As a result, economy slows down, financial service providers will have less room to make money. So in order to protect our portfolio from short to long-term underperformance as a result of value decline in financial companies, we must invest in the other 2, which is FMCG and IT. Why FMCG and IT important during recession? FMCG signifies the consumption of basics and utilities. FMCG is nothing but fast-moving consumer goods. With a population of 140 crores, will consume these goods no matter the economic conditions. Check your own household consumption pattern. You might have reduced spending on luxury items or maybe completely stopped altogether. However, for items such as packed foods, beverages, toiletries, cosmetics and so on, consumption may slow down slightly, but it will never stop completely. So the demand for FMCG products may slow down at times but will never stop altogether. The demand will be always present. That's one big reason to invest in FMCG companies and stay invested at all times. In fact, this year, the year that was known to bring recession and market correction, in 2022, the FMCG sector as a whole has given 22% ROI, the highest in the market. How about information technology? Information technology accounts for 8% of country's GDP and is expected to grow its contribution over the years, estimated to contribute around 10% of country's GDP by 2025. The Indian IT sector is growing at a double-digit rate, close to 15% per annum. It is without a doubt one of the fastest growing sector in India. But in 2022, the sector was the worst performing one, giving a negative 22% ROI. I have made a detailed video on why IT sector failed Indian investors this year, and the full blame goes to Russia-Ukraine war. Check out this video for more information. Link in the description. Anyway, both IT and FMCG should have been immune to the recession. However, both went either direction, yielding polar opposite results. Well, surprising as it may seem, this was expected when you know that the biggest consumer of Indian IT services, that is both the US and the entire Western countries, which is Europe, is in a passive war with Russia. Anyways, now that the IT sector has given negative returns and is available at around 13 to 14 PE, it is the right time to slowly add IT companies to our portfolio. Instead of buying into large IT companies, investors must also check into middle and small cap IT companies that concentrates their service around artificial intelligence, EV and agri-tech. If you are unable to pick the right company, please prefer large IT companies and invest in IT ETFs. I hope the video was informative. Any doubts and queries, please ask them in your comment section. Now let's see what ET Money Genius is all about. Hi there. Do you take stock tips, invested in them, lost money? Well, instead of repeating the same mistake, earn better returns by subscribing to ET Money Genius. ET Money Genius will understand your risk profile and suggest different investment options for varying time periods, thus helping you build a very well diversified portfolio. High quality stocks that yield better returns are chosen so that you need not wait for years. So what is the expected return? Well, if you had invested as per the ET Money Genius high growth stock strategy for any 7 years in the last 15 years, you would have earned 22.4% CAGR. The wait ends here because with no additional work, you can earn a wonderful return just by subscribing to ET Money Genius membership. Check the link in the description. Thank you for watching.